I'll give you two pieces of advice. I'd invest as much in myself as you can. I mean, you're your own biggest asset by far. I mean, you've got all kinds of potential. All the people in this room, you're lucky to be in this country, gotten a good education, but most people go through life using up a very, very small part of their potential. And so anything you do that invests in yourself, that's the best investment you can possibly make. And then I would follow my passion. I mean, whatever turns you on.
Makes my case. My whole point about this is, when you talk about quality, the definition of it as an investment strategy, it means that companies that are reducing debt, that are putting out free cash flow, distributing that cash flow in the forms of dividends or share buybacks, that are basically deleveraging. And if you look at the S&P 500, only about 138 of them have healthy balance sheets. Those are the ones I invest in. So I don't own a company that's not profitable. I don't understand why I would do that. When you invest, you put capital in harm's way. That means you want to get it back. And so to do that, you need profitable companies. The market has punished anybody that decided to take a chance on any unicorn that actually doesn't have free cash flow. And you've lost, between 20 and 50% of your capital. Why keep doing that to yourself? Why not wait until it's profitable and then determine what it looks like against all the other opportunities you can invest in? Quality is my mantra in investing. I want a great balance sheet, I want free cash flow, I want dividends, I want all of those things, I want growth.
So are you saying
called barriers to entry? You want a business where it's hard for someone tomorrow to set up a new company to compete with you and put you out of business. I mean, like going back to the Coca-Cola example. Coca-Cola has such a strong market presence. People have come to expect when they go to a restaurant, they can ask for a Coke and get a Coke. It's very hard for someone else to break in. And of course, there's Pepsi and there are other soda brands, but Pepsi's been around a long time. Coca-Cola and Pepsi have continued to exist side by side over long periods of time. So when you're thinking about choosing a company, make sure that they sell a product or a service it's hard for someone else to make a better one that you'll switch to tomorrow.
In other words, things will go well. They'll reach a point beyond which they can't get better, and by definition, they'll start to get worse. And then things will deteriorate, and then they'll reach a point beyond which they can't get worse, and then they'll get better. That's the belief of someone who follows cycles, and as you know, that's me. I've lived through half a dozen cycles, substantial economic and market cycles in my 51 years in the investment business, and I believe that we always will have cycles. The interesting thing, if you pay attention, is that when things have gone very well for a long time, people start to say, well, maybe we won't have any more cycles. Maybe it's going to go straight up forever. And of course, that is the exact time when the probability of a decline is the greatest. We're seeing that now.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks. And this is the kind of stock people like to own. This is the kind of company people adore owning. This is a relatively simple company. They make a very narrow, easy to understand product. They make a 1 megabit SRAM, CMOS, bipolar risk, floating point, data I/O array processor with an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip with a plasma matrix vacuum fluorescent display. It has a 16-bit dual memory. It has a Unix operating system, 4 whetstone megaflop polysilicon emitter, a high bandwidth, that's very important, 6 gigahertz, double metallization communication protocol, an asynchronous backward compatibility, peripheral bus architecture, 4-wave interleave memory, a token ring interchange backplane, and it does it in 15 nanoseconds of capability. Now, if you own a piece of crap like that, you will never make money. Never. Somebody will come along with more whetstones or less whetstones or a bigger megaflop or a smaller megaflop. You won't have the foggiest idea what's happened. And people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, you know, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very
But I'm big on diversification.
You're very big on
It's
diversification.
Like, knowing how to diversify well is more important than almost anything. People don't understand this.
Is that an evergreen principle, you think?
Yes, that's an evergreen principle.
Interesting.
And the reason I'm saying that, the way it is, it's almost like a casino making its money.
Okay.
Okay. The way that you do it is you get an edge. So now when you have to make a bet, I've got to bet against the whole world. The world has a view on something is reflected in the price. So when I think something is attractive or unattractive, that means I have to bet against the whole world and whether that's right or not. That's difficult. I get it right, you know, more often than I get it wrong, but I'm going to get it wrong sometimes. And so when you can take a lot of different bets, what you can do is, like the casino, you'll get your average that your bet would be, but you'll reduce your risk of one of those tables not being the table that's paying off. And so that margin, then, so I can reduce my risk without reducing my return by knowing how to diversify. And I'd say that's particularly true, important for the people who are listening, your investors. Because what they've got to
reduce risk without reducing return.
That's right.
That's the specialty.
That's right.
Elaborate a little bit more if you don't mind on that. So reducing risk without reducing the return, because a lot of times if I'm reducing the risk, it means my return's also going lower. But you're saying, no, we're reducing it without even reducing the return.
Right.
I mean, that's a high-paying skill set to have.
It's the most important thing that you could start off doing. If you have a number of equally good likely bets, but they're uncorrelated, like the casino, you know, one table is going to make me a margin like this, but take another table and it makes me a margin like this, but I might have volatility about those. Let me take all those investments that I think will make 10%, so that's my return, but they're uncorrelated with each other. That means I'll still get the 10. I don't lower my 10, but my diversification means I lower my risk. So I improve my return to risk ratio.
Is that an art that you can teach?
Oh yeah, yeah. I wrote about it there's what I call a section in this book, the Holy Grail of Investing. It's 3 pages long. And it explains basically this important thing. Because when that epiphany happened to me and how I would do it, it changed everything by being able to do that. Because
how old were you when you figured that out?
I can improve through diversification. I can improve my return to risk ratio by a factor of 5. So by diversifying, okay, the return relative to the risk, I can keep my returns the same and reduce my risk to 1/5 if I know how to diversify well. And that's why I'm explaining it. It's not all that complicated. It's simply explained in the book. But in any case, that is the Holy Grail.
I hope you guys enjoyed this video and you did find some value. If you did, please do big thumbs up and comment your thoughts below. And if you're new around here and you still haven't subscribed yet, what are you waiting for? Go ahead and hit that subscribe button and turn that notification bell on. And I'll see you guys in my next video. Invest safe.